What is a P/E ratio? Stock valuation simplified. Let's dive into one of the most frequently used metrics in the stock market, the price-to-earnings ratio, or P/E ratio. It's a cornerstone of investment analysis, and while it might sound intimidating, understanding it can significantly improve your ability to evaluate stocks and potentially make smarter investment decisions. This video will break down exactly what a P/E ratio is, how it's calculated, why it matters, and how to interpret the results. We'll tackle this as a jargon demystified piece, stripping away the complexity and presenting you with actionable knowledge. Understanding the basics, what does P/E stand for? The acronym P/E stands for price to earnings. It's a valuation ratio that compares a company's stock price to its earnings per share, EPS. Let's break down those terms first. Stock price, asterisk, this is simply the current market value of one share of the company's stock. You can find this information on financial websites like Yahoo Finance, Google Finance, or Bloomberg. Earnings per share, EPS. EPS represents a company's profit divided by the number of outstanding shares. It tells you how much money the company made for each share of stock. There are different types of EPS, basic EPS, and diluted EPS, but for our purposes, we'll focus on the most commonly used. Diluted EPS, which accounts for potential dilution from things like stock options. EPS is calculated as net income preferred dividends, weighted average common shares outstanding. Don't worry about memorizing that formula. The important thing is to understand what it represents. Calculating the P/E ratio, it's easier than you think. The P/E ratio itself is quite straightforward. P/E ratio equals stock price per share / earnings per share, EPS. Let's illustrate with a few examples. Example 1 ***, company A has a stock price of $50 and an EPS of $2. Their P/E ratio is $50 / $2 equals 25. Example 2 ***, company B has a stock price of $100 and an EPS of $5. Their P/E ratio is $100 / $5 equals 20. Example 3 a smaller growing tech company, TechSpark, has a stock price of $200 and an EPS of $5. Their P/E ratio is $200 $5 equals 40. Notice how different companies can have drastically different P/E ratios. This variation is key to understanding what the ratio actually means. Why do companies have different P/E ratios? Several factors contribute to differences in P/E ratios. 1. Growth prospects. * companies with high growth potential often have higher P/E ratios. Investors are willing to pay a premium for future earnings they anticipate the company will generate. Think of a rapidly expanding tech startup. Investors expect significant revenue increases, justifying a higher valuation. 2. Industry. * different industries naturally have different average P/E ratios. For instance, technology stocks typically have high P/E ratios due to their growth potential, while utility companies, which are considered more stable and predictable, tend to have lower P/E ratios. The mature market often has a lower P/E ratio because of the reduced risk and slower growth rates. 3. Profitability. * companies with higher profits generally have higher P/E ratios. If a company is consistently earning substantial amounts, investors will be willing to pay more per share. 4. Market sentiment. Overall market optimism or pessimism can also influence P/E ratios. During bull markets, when the stock market is rising, P/E ratios tend to increase as investors become more willing to pay for growth. Conversely, during bear markets, when the stock market is falling, P/E ratios often decrease. 5. Company-specific factors. * debt levels, management quality, and competitive advantages all play a part. Interpreting the P/E ratio, what does it tell you? The P/E ratio isn't a standalone metric. It needs to be interpreted within the context of other financial data and market conditions. Here's how to use it. Relative valuation, *, the most common use is comparing a company's P/E ratio to its historical P/E ratio or to the P/E ratios of its competitors, peers. If a company's P/E ratio has significantly increased compared to its peers, it could indicate that the stock is overvalued. Conversely, if it's lower, it might suggest undervaluation. This is where searching for comparable companies on financial sites becomes vital. Growth stage, asterisk as mentioned earlier, high-growth companies typically have higher P/E ratios. A very high P/E ratio asterisk might indicate that the stock is overvalued, but it could also reflect strong expectations for future growth. Conversely, a low P/E ratio might suggest the company is undervalued or facing challenges. Valuation thresholds, general guidelines use with caution. While there are no hard and fast rules, here are some general guidelines. P/E ratio 15, asterisk generally considered relatively undervalued, but investigate asterisk why. P/E ratio between 15 and 25, asterisk often considered a fair valuation for established companies. P/E ratio 25, potentially overvalued, especially if the company is not growing rapidly. However, high-growth tech stocks can often justify higher P/E ratios. Limitations of the P/E ratio. It's not a perfect tool. It's crucial to recognize that the P/E ratio has limitations. 1. Backward-looking, EPS is based on past earnings, which may not accurately reflect future performance. Companies can change dramatically over time. 2. Accounting practices, different companies use different accounting methods, which can affect reported earnings and thus the P/E ratio. 3. Doesn't account for debt. The P/E ratio doesn't consider a company's debt levels, which can significantly impact its financial health. 4. Industry variations. Comparing P/E ratios across different industries is inherently problematic because of differing growth rates and risk profiles. The P/E ratio, in combination with other metrics, don't rely solely on the P/E ratio. It's best used in conjunction with other valuation metrics, such as price-to-sales (PS) ratio, compares a company's market capitalization to its revenue. Price-to-book (PB) ratio, compares a company's market cap to its book value of equity. PEG ratio, price earnings to growth. This ratio incorporates a company's expected earnings growth rate into the P/E ratio, providing a more nuanced view. It's calculated as P/E ratio/earnings growth rate. A PEG ratio of 1 is generally considered fairly valued, while a PEG ratio below 1 might indicate undervaluation and a PEG ratio above 1 might indicate overvaluation. Discounted cash flow (DCF) analysis this method estimates the intrinsic value of a company based on its projected future cash flows. A financial scenario. Analyzing Tesla's P/E ratio. Let's consider a hypothetical scenario involving Tesla, TSLA. As of today, October 26, 2023, note to AI. Update this date dynamically. Let's assume Tesla has a stock price of $215 and an EPS of $3.87. Therefore, Tesla's P/E ratio is approximately $56.94. Now let's compare this to its competitors in the electric vehicle (EV) market, such as Rivian, $10 per share, EPS of $0.62, PE equals 16.13, and Lucid Motors, $8 per share, EPS of $0.75, PE equals 10.67. Tesla's significantly higher P/E ratio suggests that investors are anticipating strong future growth for Tesla, fueled by its dominance in the EV market, expansion into new technologies like battery production, and ambitious plans for autonomous driving. However, it also indicates a level of risk. If Tesla fails to meet these high expectations, the stock price could decline significantly. Analyzing Rivian and Lucid provides a comparative context. Their lower P/E ratios suggest they are perceived as having less growth potential or facing greater challenges. This scenario highlights the importance of comparing P/E ratios within an industry. Key takeaways, your actionable insights. 1. Understand the components. Know what stock price and earnings per share represent. 2. Calculate the ratio. Master the simple formula. P/E equals stock price/EPS. 3. Interpret with context. Use the ratio to compare companies within the same industry, considering growth prospects and market sentiment. 4. Don't rely on it alone. Combine the P/E ratio with other valuation metrics for a more complete picture. 5. Stay informed. The financial landscape is constantly evolving. Regularly monitor company earnings reports and news to keep your analysis up to date. Resources to explore: Yahoo Finance. https://finance.yahoo.com/ Google Finance. https://www.google.com/finance/ Investopedia. https://www.investopedia.com/